Hello and welcome back to the Geordie Pig Investor channel. Today I'm going to be going through, is Rio Tinto PLC stock a buy right now? So, what is Rio Tinto? Well, it's one of the biggest mining companies in the world. The firm's segment include iron ore, aluminium, copper and minerals. The firm operates an integrated portfolio of iron ore assets which include a network of 17 mines, 4 independent port terminals and a rail network spanning approximately 2,000 kilometers. The company also includes diamond mining, sorting and marketing, as well as lithium exploration. Some key stats about Rio Tinto: they are based in the United Kingdom. They are in the metals and mining industry, as I've just mentioned. Their market cap is a massive 81.4 billion. They were first made into a public company in 1973, have over 49,000 employees. Unfortunately, they don't have a dividend growth streak right now because last year they cut their dividend slightly, but they have had a 5-year dividend growth streak of over 7.38%, which is very promising, and a very nice yield at 6.81%. Over the last year, they are actually slightly up, being up 4.5%. But with the mining sector, you've got to be very aware that it is quite volatile and it's going to be up and down quite a lot. Hence, as you can see in that graph, it has had quite a few peaks and troughs over the last year. Let's have a little look into Rio Tinto's earning calls, their most recent one. So they delivered solid earnings with 5.7 billion in underlying earnings. They had a free cash flow of over 3.8 billion and a return on capital employed at 20%. Their production actually increased by 5% despite an unchanged net debt of around 4 billion. The company is set to return 2.9 billion in dividend payments. The market, however, presented challenges with soft demand leading to a 14% drop in iron ore prices, and there's also declines in copper and aluminium prices, which isn't going to be great for Rio Tinto over the short term. The company has incurred an 800 million impairment for its aluminium refiners, due largely to regulatory costs of carbon credits in market conditions. So despite a 25% EBITDA decline to 11.7 billion, driven by lower prices and costs, Rio Tinto is now starting to really heavily invest into the low carbon technology expansion and recycling part of the company. And this is in projects such as Simandou. The fundamental analysis: it does have a very good positive free cash flow right now, has exceptional 3-year average ROI, has positive operating income, positive gross profit, high interest coverage, very low debt to equity, and solid long-term and short-term solvency, which is always important to have in a company, especially for the long term. So, moving on to Rio Tinto's free cash flow. Just a quick description on what free cash flow is. It's the money a company has left over after it's paid for all of its expenses. Free cash flow has a massive impact on what direction a company may be heading. The graph on the left-hand side, as we can see, is Rio Tinto's free cash flow over the last 11 years. And from this graph, you can see it has made great progress since 2013 because it had negative free cash flow back in 2013. It steadily grew from 2013 right the way up to 2022 where it had its peak. And you can notice throughout the pandemic in 2020 to 2021, it was actually still able to maintain and actually grow their free cash flow position, which is a very good sign. But due to the prices of iron, copper and aluminium going up recently, it has had that slight decline lately, and they've also been heavily investing into that low carbon tech and recycling projects. So although their free cash flow has dipped over the last year to two, this is hopefully going to pay off long term. They do have a free cash flow payout ratio at 64%, which isn't too bad. I always say if it's under 70%, it's pretty healthy, and the fact that they are still growing their dividend payment and their free cash flow is likely to hopefully start increasing again in the coming years, I'm quite comfortable with this amount for this company. Rio Tinto's discounted cash flow valuation, also known as DCF. So the DCF is a method of estimating the current value of a company based on projected future cash flows adjusted for the time value of money. The DCF valuation process calculates the present value of a company's forecasted cash flow based on a selected operating model. Just a reminder that Rio Tinto's price is currently at 5,078 GBX, and once I've plugged in the numbers of a discounted rate of 9% with a terminal growth rate of negative 2.8%, you can see that on the worst case scenario, it's looking like Rio Tinto will be valued at around about 2,703 GBX, which would be an overvaluation of 47%. On the base case, we can see that it was valued at 5,280 GBX with a discounted rate of 8.5% and a terminal growth rate of 0. And finally, in the best case scenario, it was undervalued at a massive 53% with a growth rate of 2.8% and a discounted rate of 8%, being valued at 10,732 GBX. So you can see there's quite a difference between the three valuations here, but I always like to get multiple valuations so I can gather information from all three. And then I'll usually use my base case as that is the most likely outcome. But it's nice to have valuations either side as well, just so then you would be aware of the potential downswings, but also upswings that could happen. The next valuation we're going to look at for Rio Tinto is a relative valuation. So we use the relative valuation because this, combined with the DCF model, will create the intrinsic value. But relative valuation is a method used to value a company by comparing it to its other competitors based on certain metrics. Earlier I mentioned something called EV to EBITDA. That stands for earnings before interest, tax, depreciation and amortization, and that is one of the metrics that is used in the relative valuation. We also use PE ratios and EV to revenue. There's also multiple other metrics that you can actually use, but these are the main three that I personally stick to when working out my relative valuations. So when plugging in the numbers, Rio Tinto and the worst case scenario was overvalued at 28%, being valued at 3,666 GBX. The base case was an undervaluation slightly at 7%, being valued at 5,453 GBX. And the best case scenario came at an undervaluation of 26%, being valued at 6,874 GBX. So like I just mentioned before, by combining these two, we're going to come up with something called the intrinsic value. The intrinsic value is very easily calculated, as all we have to do is add the two together and divide by 2. So as we know, Rio Tinto's price is at £50.78, also known as 5,078 GBX. So for the intrinsic value, when we add these two together, for the worst case, it came out at 3,184 GBX, average case being 5,366 GBX, and the best case coming out at 8,803 GBX. From here, I like to get one final valuation, which is the Wall Street estimates. Wall Street estimates are an average estimate of a public company's quarterly earnings and revenues that lead to a valuation of that company. These numbers are forecasted by a company-specific analyst who provides research on that particular company and therefore comes up with what they believe is an accurate valuation. There aren't just one analyst who would come up with this, it's multiple analysts, especially for the bigger companies. So a company as big as Rio Tinto is going to have multiple analysts going through the company day by day, checking its incomings, outgoings, how the company's operating, and will then come up with a valuation. When this valuation is created, it is then expected to hit these numbers when the earnings reports come out. If it isn't to hit these numbers, that's when potentially a stock may decrease in price, and if it exceeds these numbers, then that's potentially when a stock may go up in price. So the Wall Street estimates valuations for Rio Tinto were a worst case of 4,545 GBX, an average case at 6,125 GBX, and a best case at 8,295 GBX. So now that we have all three, we can now add these together and then get the average between all three of them and come up with our final valuations. Our worst case valuation, when adding all three together, comes out at £36.38. Our average case comes out at £56.19, and our best case comes out at £86.33. If we were to use a 10% margin of safety on the worst case, we'd be looking to buy at £32.74. And with a 20% margin of safety on the worst case, you'd be looking at buying at £29.11. These figures are quite clearly very far off of Rio Tinto's current price, and hence why I think it's so important to not just get one valuation. And that's why I like to have the average case as being my most accurate, because going off of previous stocks I've invested in, I've had a lot of success using the average case as my personal choice. With a 10% margin of safety on the average case, you'd be looking to buy it around about £50.58. And with a 20% margin of safety on the average case, you'd be looking to buy it around about £44.96. And then the best case, you'd be looking at buying at £77.70 for a 10% margin of safety, and for a 20% margin of safety buying at £69.07. So what does this mean then? Well, my personal conclusion is Rio Tinto stock to buy right now. I personally think the company has some really strong core fundamentals, and I like the fact that it continues to look at long-term projects as well as having some good short-term numbers. The mining sector is known for being extremely volatile, so you have to be prepared for the price to fluctuate up and down, and it's going to have a lot of swings. It does boast a very good dividend growth rate as well as a high yield, both being up over 6%. But not having a dividend growth streak is a little bit alarming and could potentially mean that dividend cuts could come in the future. Although it does only have a 64% payout ratio, and I do believe there is still room for growth there. Alongside this, my current valuations show that even on the average case scenario, it still does seem a little bit overpriced. Personally, I won't be buying at the current price right now, but if the stock was to drop down to closer to that £45 to £47 mark, which would be in between my 10% and 20% margin of safety on the average price, I may be happy to add to my position. I do have a current position with Rio Tinto, and I'm very happy to hold this position and will not be looking to sell that anytime soon. I hope you enjoyed the video today. This was the full breakdown on Rio Tinto. If you'd like to know of a different stock, please let me know in the comment section down below and I'll potentially be able to go through it. Thanks for watching. Please like and subscribe. And this is the Geordie Pig Investor. Over and out.